Okay, so let's just dive right in. We've all been there, right? You have a couple of winning trades, you feel like you've cracked the code, and then bam, the market serves you a really humbling punch.
Oh, absolutely. And that difference between, those volatile emotional streaks and genuine long-term success, it isn't luck.
Not at all. It's about having a measurable advantage. In the high-stakes world of trading, we call that your trading edge.
It's the single concept that separates those who treat trading like a high-risk hobby from those who approach it as a professional discipline.
Right.
And our source material for today, the insights from Bell's Forex, they confirm this. An edge is what fundamentally sets consistently profitable traders apart. It's a combination of unique insight.
And that could be anything, right? Not just one thing.
Exactly. Whether that's specialized knowledge, a
Yeah.
proprietary strategy, or, and this is crucial, superior behavioral control.
I find that so fascinating because it means the edge isn't purely technical. It's not just about finding some magic indicator on a chart.
No, it's much more holistic than that.
So our mission for you, the listener, is to try and shortcut that often really painful process of discovering this edge. We are going to synthesize the exact strategies you need to transition from being reactive
Chasing momentum, getting caught in the noise.
to being proactive, someone who executes with real confidence and consistency.
And that transition is, it's the make or break moment for intermediate traders. You probably know your moving averages, you understand basic risk, but without a defined edge, you're just playing the market's game.
You're just reacting.
You're reacting to events instead of anticipating them. So developing that unique advantage is really the non-negotiable foundation for any kind of long-term profitability.
So let's start with the why, the essential rationale. Why does defining this advantage matter so much, especially when the market is just so loud and confusing?
Well, the simple answer is clarity and consistency. Without a defined, measurable edge, you are, for all intents and purposes, flying blind. You become prone to emotional decision-making, panic selling, or, greedy over-leveraging because you just don't trust your system.
You have nothing to fall back on.
Precisely. The edge acts as your decision filter, gives you the confidence you need to stick to your strategies, even when volatility spikes. Because, statistically, the odds are tipped in your favor over a large number of trades.
It's the difference between guessing where to shoot and having a sniper rifle with a custom sight. And our source material highlights that the ingredients for this sight come from three main areas: technical, fundamental, and psychological insights.
Absolutely. Think of it like this. The technical analysis gives you the entry signal. The fundamental analysis gives you the context, the environment. But the psychological insight, that's what ensures you actually pull the trigger correctly.
Without hesitation or second guessing.
Right. The goal isn't just to adopt a strategy, but to tailor an advantage based on your unique skill set. Maybe that's superior number crunching or keen pattern recognition or just mastering market fear and greed.
All right, let's get practical then. Let's start building this thing. The first critical step outlined in our sources is maybe the hardest because it requires some brutal honesty. It's the internal assessment.
It is. The journey always begins internally.
Knowing yourself better than you know the market.
That's a great way to put it. You have to rigorously assess your personal trading strengths and, critically, your weaknesses. And this isn't just a vibe check,
Right. Not just, I'm feeling good today.
No. We're talking about quantifying things like your true psychological risk tolerance. How much drawdown can you really stomach without interfering with the trade? Your core market knowledge and the measured efficiency of your decision-making under duress.
But that self-assessment can be so subjective. I mean, how does a trader move beyond just saying, I'm good at reading charts, and turn that into something actionable, something you can actually measure?
That's the key question. And you quantify it through performance metrics and journaling. You should be using backtesting results to see exactly where your strengths lie.
Okay, so hard data.
Hard data. Is it short-term momentum scalping or is it long-term structural trades? If you find you have a, say, 70% win rate on trades that last less than 60 minutes, that's a quantifiable strength. You leverage that.
And on the flip side,
If your metrics show you're terrible at holding positions overnight because you get spooked by the news, that's a weakness you eliminate. The goal is to leverage those natural, documented abilities to develop an authentic edge.
so once you've mastered that internal assessment, you know what kind of hunter you are. The next logical move is to look outward at the terrain, which brings us to finding your niche market opportunities.
And niche markets are where edges are often strongest because, simply put, reduced competition means higher profit potential.
Right. It's a smaller pond.
Exactly. If you're trading the EUR/USD, you're competing against every bank, every hedge fund, and every retail trader on the planet. Your advantage gets diluted.
So give us an example. What's a valuable niche that an intermediate trader could actually exploit?
Think specific instruments or specific time frames. Maybe you become an expert in illiquid currency crosses. Pairs that major institutions don't bother with because the volume's too low for them.
But which might have predictable price action.
Exactly. Predictable because of local supply and demand dynamics.
Yeah.
Or perhaps you focus solely on the volatility crush in options markets right after a major economic data release. These specific areas provide unique opportunities that a broad market generalist will completely overlook.
It's about finding that shallow end of the competitive pool where your personal skills can truly dominate. But to confirm that, you need to understand what everyone else is doing. And that leads us to competitive analysis.
This is where you put on your detective hat.
I like that.
But it's not about imitation, it's more like market archaeology. The technique involves studying other successful traders' strategies, their fund reports, to gain broader market insights. We're not looking at specific entry points.
You're looking for their logic.
You're looking for institutional behavior. For example, where are the significant volume spikes that tell you large players are entering or exiting? What price levels do they persistently defend?
You're essentially looking for footprints in the sand. If you can reverse engineer the logic behind a successful dominant strategy, you gain insights that help you refine your own approach.
And you make sure your system doesn't accidentally become bait for those bigger players.
Exactly.
It reveals where the market is most crowded, and more importantly, it can highlight areas where the broader market might be weak, maybe in managing counter-trend moves or handling low volatility environments. Once you find that weakness, you can design your edge to exploit it.
But the moment you find an exploit, the market starts working to close it, which is why the sources stress the absolute necessity of innovation. If you stay rigid, your edge will decay.
Edge decay is real, and it is rapid. Think about the classic simple moving average cross strategy. 10 years ago, that might have been profitable. But the moment millions of retail traders and simple algorithms adopted it, the market learned to exploit it. It turned into noise. That advantage probably vanished in, 3 months? Innovation is about adaptation. It's about constant forward movement.
So how does an intermediate trader practically innovate? Does it mean inventing some brand new indicator?
Not necessarily, no. Often, innovation is about applying established concepts in a novel way, or tuning parameters to your own proprietary specifications.
For example?
Well, maybe everyone is using a standard 14-period RSI. But you discover that a specific 23-period RSI, applied only to a highly volatile currency pair in the Asian session, provides a statistical skew. That specific application is your innovation.
It's a small tweak that creates a huge advantage.
And that sustainable advantage keeps you ahead of the curve. Which brings us squarely to the modern tools that facilitate all this, leveraging technology and data mastery. These aren't luxuries anymore.
No, they're foundational to a 21st century edge.
Technology is the multiplier for your edge. We're talking about leveraging trading algorithms, automated systems, advanced charting tools. But the key insight here is that the edge isn't just having the software.
It's how you use it.
It's coding your proprietary parameters and rules into the system. This drastically improves the speed and precision of your execution, and, maybe most importantly, removes the emotional element entirely.
An automated system doesn't hesitate. It doesn't feel fear.
Exactly. And that is crucial. The algorithm executes the strategy, but that strategy is only as good as the data it's built on.
So how does superior data analysis enhance that edge?
Data analysis moves you beyond just looking at basic price charts. It's about deep interpretation of historical and real-time data to find patterns that others miss. A basic trader sees a trend line.
A sophisticated trader sees what?
A sophisticated trader analyzes order flow dynamics, volatility clustering, or intermarket relationships. The subtle connections between, say, bond yields and currency performance. You're hunting for statistical anomalies that create temporary, predictable inefficiencies. That specialized pattern recognition, derived from deep data work, is the advantage that elevates you above the noise.
Okay, so we've identified our strengths, we've found our niche, we've built a system using cutting-edge data and tech. Now comes the hardest part, making sure it all keeps working when the world changes.
The maintenance and adaptation phase.
Right. starting with what the source calls adaptive trading systems.
Because markets are not static. They shift between high volatility trending phases and low volatility consolidating phases. If your system is rigid, it will perform brilliantly in one environment
And fail spectacularly in the other.
Exactly. Adaptive systems are designed to be flexible, to be responsive.
What does that look like practically? I mean, how does the system adapt without you constantly interfering?
It's all defined by dynamic criteria. An adaptive system might automatically switch from a momentum-based indicator set to a mean reversion set the moment realized volatility drops below a certain threshold.
That's smart.
Or it might employ dynamic position sizing, automatically reducing leverage during known news events and increasing it when the market structure confirms your entry. This built-in flexibility is essential for maintaining consistency.
And these adaptive systems, they necessitate the next component, continual edge refinement. This really reinforces the idea that developing an edge is not a project with an end date.
Absolutely not. You must constantly be optimizing. This means continuous backtesting against new market data, forward testing parameter variations, and staying updated not just with market trends, but with new tools and new capabilities.
If you stop refining, your edge starts decaying immediately.
Immediately. Because the competition is always hunting for their own advantage. It's just an ongoing feedback loop of learning and adaptation.
And none of this, no matter how automated it is, works without serious screen time. Our source really highlights the vital role of experience.
Experience is the intuition that complements the analytical edge. It's developed by reflecting deeply on past trades. And we're talking about learning from successes. What did I do right that I can institutionalize? And learning from mistakes. Why did the system break down in that specific scenario?
It's the human element, the part that can handle the unexpected.
Exactly. It sharpens your decision-making and allows you to recognize subtle market shifts that an algorithm alone might miss.
Which brings us to the final, and I think maybe the most vital step in this whole process, protecting your trading edge.
Absolutely vital. If you've gone through all this effort to build a unique proprietary advantage, specialized knowledge, unique tools, superior behavioral control, you have to safeguard it from dilution or loss.
Because the moment your specific technique becomes widely known,
It stops being an edge.
Right.
It just becomes another market feature to be exploited by others.
So how do you protect it? Especially in a world of open forums and social media where everyone wants to share their secret sauce.
Protection means keeping your specific system parameters, your internal data sources, and your unique insights closely held secrets. It may involve working under non-disclosure agreements if you partner with developers.
Or just keeping your mouth shut.
Or creating enough complexity in your system that even if people know the general components, they can't replicate the precise interaction of those components. Sustainability really depends on exclusivity.
This deep dive truly synthesizes the idea that a well-defined edge, whether it's based on technical prowess, specialized knowledge, or that critical emotional control, it transforms trading from gambling into strategic execution.
It leads to more informed, disciplined decisions. And that psychological element deserves a final mention because really it underpins everything else. As the suggested reading list in the source confirms, authors like Mark Douglas, in Trading in the Zone, focus specifically on overcoming emotional biases.
The strongest edge in the world is useless if fear causes you to bail out of a winning trade too early.
Or greed causes you to hold a loser for too long.
Right. And that's why it's so critical to customize your advantage. You see this reflected in the variety of approaches documented by Jack Schwager in his Market Wizards interviews. There is no single holy grail.
Not at all. Joel Greenblatt's success, for instance, in the little book that still beats the market, relied on a systematic, almost mechanical approach using fundamental analysis. It just proves that consistency, tailored to your strengths, is the real winning formula.
So to synthesize this entire process, I think the core idea is this. The goal isn't just to find a profitable strategy for today.
No, it's to cultivate a strategy so refined, so personalized, and so well protected, leveraging your unique psychological strengths, your proprietary data, and an adaptive mindset, that it becomes fundamentally difficult for the broader market to exploit or copy. That difficulty is your long-term guarantee of sustainability.
Before we leave you to absorb these strategies, we do have to adhere to the mandatory risk warning provided in the source material. Trading financial instruments involves significant risk of capital loss. Market volatility may result in rapid value fluctuations, and investors may lose more than their initial investment.
And remember, we provide educational content only, and this is not financial advice. Please consult a licensed financial advisor before making any investment decisions.
So we'll leave you with this provocative thought for your own continued deep dive. Considering the 10 components we've just mapped out, from assessing your strengths and finding your niche to leveraging technology and protecting your methods, which of these areas represents the weakest link in your current strategy?
And what is the single next step you can take right now to strengthen and protect that unique advantage?